you talk to any real estate investors, they have some journey where they started out somewhere, accidental landlord, or their dad did something, or their mom, or they knew somebody in the business, and they go and try stuff, and you can fail and still succeed. And that's one of the things I really like about real estate investing, and the communities that you can build. Everyone's willing to help. It's not like if I do a deal, it's taking something from you. There's so much sharing and so much information that you can provide to others and get from others.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, is John Cohen. How's it going, bud?
We are doing good. We are, this will probably air after, but we are coming up close to 2021, which I think everybody is going to be super excited about, although it looks like it's going to start off pretty poor. But hopefully it gets better at the tail end of that, and we see how it shakes out. But we're hanging in there. We are having a rip-roaring New Year's Eve party, me, my wife, and my 2-year-old daughter. And, we'll see how that shakes out. But, it is what it is.
Yeah, I think, we've all been saying ready for 2020 to be over. And I think it's just going to be very anticlimactic, where it's going to like flip to the new day and you're waiting for something and then everything's going to be the same old shit. We're going to be dealing with the same stuff. Nothing's going to be changing. And it's just going to be like, oh, that was kind of a letdown.
You might be a little, more or less, that you might be a little long, but this is like Y2K, when everyone thought like midnight was going to ring and the world was going to come to a ripping halt.
I was too young for that.
I feel like this year is the, people think the ball's going to drop and everything's going to go back to normal. But, I don't foresee it happening that quickly, especially being that we're like 72 hours away. So we'll see how it shakes out.
Yeah, it's crazy. It doesn't even feel like it's the new year. I feel like I've just gotten used to saying 2020 instead of, 2000 and something, 2019, 2018. Now it's 2020. Now it's 2021. And I'm just not ready for it. So, I am, but I'm not.
I told my wife the other day, in 80 years, when you write the date, you're going to write 00. So in January, you're like 1100. It's like, it's going to be different because 2020 had the, you had to sort of finish the date because you couldn't just leave it at 20 because people could have forged stuff. But because no one left their houses, that was not a big deal. But I said, hey, look, in 80 years, it's going to be 00, which will be interesting. I won't be here, but for the very, very young generation, hopefully listening to this in the future, it'll be crazy times.
Yeah. And for those that also don't know, my birthday also happens to fall on the new year. So every new year is just another digit closer to 30. So 29, 1 year left of having a 2 in front of my age. So it'll be an interesting last hurrah before I hit that big 3. So we'll see how that feels.
I could say 21 was the only birthday where you felt a little different. Other than that, it's the same shit. You're just getting older. You hope it doesn't happen.
Exactly. With that being said, let's jump into today's episode. We got a great guest on today. I think we're going to get a ton of insights from him. I'm excited to hear his story. So with that being said, Jim, thank you so much for joining us.
Thanks, guys. Happy to be here.
Yeah. So why don't you kick us off? Tell us a little bit about you, your background, your journey, and what you're doing.
Sure. So right now I'm a full-time passive investor, and the way I got here is kind of a roundabout way. I think it's kind of how everyone kind of gets to passive in a strange way. I think, my first 20 years out of college, maybe even 30 years out of college, I was a stock market guy, investing in stocks and mutual funds and, subscribing to magazines and all that. And, I had a couple different careers in business, and then I was a finance teacher for a while. And then I became a financial advisor. And, I thought I was perfectly suited to it because I'd been so into finance my whole life. I mean, my graduation present from college, my parents bought me, some shares of a beer company. So I had been into that. And as I learned more about finance and being a financial advisor, I found out that I was more interested in real estate. And so part of it, if you step back a little bit too, I was an accidental landlord. In 2008, we bought a new house and moved from our old house into our new house, and we couldn't sell the old house because everyone knows, I was right at the worst possible moment. So we found a tenant, and family moved in. They lived there for 5 years, and I didn't really track whether we were making money or not. I wasn't really that interested. I just knew we couldn't sell the house for the price we wanted. It's just normal story. Christmas Eve, I get called in to fix a bathtub or a leak or something. And so finally, when the market changed, I talked to a realtor, and I said, I just want to sell the house. And he said, well, why don't you just let me manage it for you? And I thought about it, and he kind of talked numbers through it. I'm like, oh, okay, yeah, I'll try that. So at the time, that house, we had it paid off. And I didn't really understand that, that much equity in a house is just dead equity. You don't earn anything from that. So talking to him, he's like, well, why don't you just refinance it and we'll buy a couple more? So I did that and bought 2 more single family homes. I live in Columbus, Ohio, and they're both, in nice A-class neighborhoods here. And that kind of got my juices flowing. And at the same time, I was, doing financial advising, and I was kind of getting more into more real estate. And so we did a flip because I was just kind of experimenting with different things. And I joke, but we made hundreds of dollars on the flip. Mm-hmm. And anyone who's into flipping knows that is not the proper strategy. We spent 9 months and made a couple $100, and it was just, we got saved by the market. The market increased, but we did everything wrong in the flip. So I was like, never doing that again, but it was a great lesson. That got me into turnkey investing, which is buying single family homes that are fully rehabbed, and, it's more passive. Someone else is doing all the work. You just got to find the home. And from there, once I figured out that single family homes were a good investment, then I thought, well, multifamily must be much better because it's more doors. I see the higher cash flow. And I was mostly in A-class properties up to the time, but then I looked at the numbers, and boy, the C-class properties had great cash flow. So I thought, well, I'll just buy a duplex or a fourplex. And so I talked to my realtor, a different realtor, because the other guy said, you're an idiot if you go into multifamily. So I found somebody else and bought a 22 unit. So it was a little bit bigger than the 4 unit I was planning on. But I just kind of went step by step, made the offer, and kept putting obstacles in the way, thinking the buyer or the seller would back out, and they kept agreeing to everything, which should have told me something. So I ended up buying a 22, then I bought an 8, then I bought a 4. And so, and that was all in the space of like 3 or 4 months. And looking back at it, I really, I didn't do a very good job on those of managing them, because I was trying to do all the rehabs and fill all the units with cash flow rather than having prepped for it and put money aside for that. And so anytime my property manager would say, hey, we got to evict someone, I would beg him not to, but I'm going to lose that, $600 a month. I can't, needs the cash flow. So I kind of figured I was just doing it wrong. And so I ended up selling those properties a couple of years ago. And again, my story so far, rescued by the market. Anyone can make money in multifamily. They basically doubled in value over a couple of years. I sold them and started getting into even more passive investing, which is the syndications, which is my focus now. I started in those because I had a 401k from one of the previous jobs that I had. And I went to the real estate guys had a syndication seminar. And I went down there thinking I was going to be a syndicator. And I left there knowing that I didn't want to be a syndicator, but I really liked the idea of this passive thing. And so, I had a pretty sizable self-directed IRA, and I basically invested in everything that from people that I met at this seminar. So I wasn't really doing any due diligence that I should have. I was just like, shiny object, buying, I like that guy, I'll jump into his syndications. And none of those have turned out poorly. But if I had to do it over again, knowing what I know now, I probably wouldn't have done those. But that opened up my eyes to passive investing in syndications. And when I sold those multifamilies, kind of jumping back and forth here, when I sold those multifamilies, I went to my accountant and I said, how can I, I'm going to have this big capital gain. What do I do about that? We went through the, 1031. Well, I didn't want to do that because I didn't want to get a larger building. I wanted to get out of, the more active stuff. And he said, sometimes you just got, when you make a bunch of money, you just got to pay taxes on it. But he said, you can also do what I call lazy 1031. And the lazy 1031 is buying into these passive syndications. They get a big bonus depreciation, cost segregation up front, and that negates a lot of the tax. So that's what I did. And that really got me into the syndications. And that brings us almost up to current where I had a networking group that I had started when I was doing all the multifamily stuff, and that had grown pretty big. But I wasn't doing that anymore. So I kind of had a spin-off group of that little meetup, and got a group of 12 people who wanted to talk about passive syndications. We were going to go out to dinner and, meet monthly for dinner. And our first meeting was supposed to be March 18th. And it's 2020, as you guys said. And Ohio shut down on I think the 15th was our last open day. So that meeting was canceled. But, that's the one good thing that's come out of the pandemic is all of a sudden our meeting was on Zoom. And instead of just having local Columbus people, I could invite some of the other people that were interested from out of town or just other contacts that I had. And the best part about it is now I could invite actual guest speakers, syndicators, experienced investors. And so this group that I was trying to purposely keep small because it was going to be like my own little mastermind. And I was the only one there's one other guy, me and one other guy had experience in passive investing. And so I thought I was going to be sharing my knowledge and doing this great service to all these people. What I learned was, as I was having these conversations and as we were having these meetings, I learned a ton and I really grew as an investor. And so we've had, monthly meetings since then. And then as we started talking to more and more people, we decided we needed to brand the group and grow it a little bit. And so we became a community that we call the Left Field Investors is our community. And now we have monthly meetings, we have a website, and we're kind of building a community, of just like-minded individuals that are interested in creating financial freedom through passively investing in real assets that generate real cash flow. That's kind of our motto. So that's my long, winding story.
No, I love it. I think it's awesome. It's great for me, and I'm sure a lot of people to hear that, you made so many mistakes or errors or, things along the way, and you're able to still overcome them, find your way. Maybe you got help by the market or whatever, but you're still able to get through it. Because I think that's a huge fear for a lot of people of putting money in, committing capital and messing it up and losing their shirt or losing more, especially if you use leverage. I think it's going to be comforting or interesting for a lot of people to hear that, hey, I was able to do this several times, mess up multiple times along the way, and you're still here kicking and living and what sounds like actually thriving. So I think that's important for people to hear.
Yeah. And I think that's a real estate experience, right? I mean, that's what you talk to any real estate investors, they have some journey where they started out somewhere, accidental landlord, or their dad did something, or their mom, or they knew somebody in the business, and they go and try stuff, and you can fail and still succeed. And that's one of the things I really like about real estate investing and the communities that you can build. Everyone's willing to help. It's not like if I do a deal, it's taking something from you. There's so much sharing and so much information that you can provide to others and get from others. And so, once you kind of get hooked, I can't stop talking about it because, real estate is so interesting and so necessary, right? It's one thing that bothers me about the financial industry. I had to give up a bunch of my licenses because I wanted to do some investing together with people, but also they call what we do alternative investments, right? It's not alternative. It's where people live. It's where people, go. It's everything. It's actual real stuff where, to me, the stock market is speculation, right? You're buying a piece of paper. Now it's a digital piece of paper, hoping that it'll go up. And when it's at the highest point, you want to sell it to some other person who, is going to hope it goes up from there. And, that's where I changed my whole focus is what I want is real assets that produce cash flow. So if, I don't know what 2021 is going to be, but if all the assets that I'm a partial owner of decrease in value, that's not really going to affect me because the cash flow will still be there. Now it might decrease some, but, it hasn't decreased even in 2020. Most people are paying rent, some of the syndicators stopped distributions, but they paused and they're going to still pay that money. So, I'm a big believer in assets to produce cash flow. That's my whole thing. Now, it took me a long time to figure out how to get there. It was a years long process, but now that I'm there, I'm pretty committed to it.
Mm-hmm. Yeah. I think it's interesting too, because I got to imagine being on the flip side of the coin where if you are somebody that is looking to be passive, maybe not active, which I commend you for realizing very early, not wanting to be a syndicator and taking that step back. Because a lot of people probably wouldn't do that. They would feel like, it's a loss or, they are quitting or something like that. So I think that's awesome. But I'm sure it's tough to get a lot of information you're looking for as a passive investor, because a lot of the resources are from people who are syndicating or are raising money or are selling courses. And it's got to feel like it's tough to know if you're really getting good information or not without some sort of ulterior motive behind it. Was that one of the reasons that you wanted to put together that meetup in that group, or was it something else?
No, you hit it. Absolutely. I mean, the thing is that the most syndicators I talk to are so willing to share their story and share information. And, it's the whole know, like, and trust, right? That's a big thing in the real estate community. You got to know, like, and trust someone before you put money in with them. But these deals take so long to pan out, and you have to put in so much up front that, finding a group where you can share stories and share experiences. I mean, a lot of these things, when I jumped into it, I was like, when I went to the real estate guys conference, I had to spend $1,500 on this trip, and I didn't know if it was for real or not. But I'm like, oh, okay, I'll do it. Same thing when I bought into my first syndication. I did it in my self-directed IRA, which I thought, okay, if this blows up, it's retirement money. I have time to make that back. But I still felt like, I just don't know. And so when I started this community, that's exactly what I wanted, is to get a group of people who are doing the same thing. And I remember there's a guy in our group who he was the only other one who had done any passive investing before. And we started talking, and he was in a couple of the same deals I was. And a sense of relief, just that this is a guy who thinks he's a smart guy, and he's in the same thing I am. So either we're both smart or we're both idiots, but we're in it together, was kind of my feeling. And the more, every time I meet someone else who's in the same investment as me, it just gives me a sense of relief, because it is very hard to break into this. You have to dole out 25, 50, 100 grand for each of these investments. And that's one of the things in our group. We do some investing together where we use this platform called TribeVest, and it allows you to kind of group people together. And it's just a platform that makes it easy to do. And so I'm in 4 different tribes investing in a bunch of different deals. So I invest on my own account. But, the one good example is me and this other guy I met at another seminar I went to. We wanted to get in the same syndicator was doing a bunch of deals, and we wanted to get into all of the deals. But, if they do 12 deals a year at 25 grand a pop, you run out of capital eventually, right? Mm-hmm. So we decided to team up with this guy and his brothers and dad, and we have a group of 5. And so now instead of 25 grand a pop, we're 5 grand a pop. And so we can get in every deal. So you get a diversification of, location and deal and all that.
Mm-hmm. It's funny you bring that TribeVest up, because we actually had the CEO on, I don't know, probably 4 or 5 months ago talking about it. I think it's a great platform and a great tool. So it's interesting to hear, he really talked about how people were using it to buy their own deals, like house, duplex, things of that nature. So it's interesting to hear you talk about it, using it in a slightly different manner, but still utilizing it in a very similar way. And I'm sure that'll help some people who, very similar to you, want to get into passive investments, or especially younger people, or maybe who aren't accredited yet, or just don't have the discretionary capital yet. A lot of times, like you said, there's minimums, and even ones that are larger have larger minimums. If you just can't float $25, $50, $100,000, you put together 3-5 people, it might help out. So I think that's a really good tip. Was there anything when you put together this group, and as you've been doing it over the past, let's say 6 to 9 months, what are some of the things that you've learned from other people? Because you said you learned a lot on either the passive side, the syndication side, or just in general that you've found extremely helpful.
I think there's a lot of things, but part of it is, I started this group. I passed myself off as the expert. And so part of it was just the preparation. When a meeting was coming up, I knew that I wanted to, so I taught myself so I could teach others. That was part of it. I think other parts were just, we put together some tools in our group. One is a deal analyzer. And what I didn't know, like when we first invested in these deals, me and this other guy, Steve, we kind of we would make sure we know, like, and trust the operator. But when the deal came, they all looked the same, right? So we weren't sure how to figure out which was one was better than the other. So we put together this deal analyzer. And I didn't want to re-underwrite the deal. That's the job of the syndicator. That's not my job. I want to be able to look at a deal in 20 minutes and decide whether it fits my parameters. First I look at the operator, know, like, and trust. Then I look at the area, the market, if that's something I like. And then I look at the deal. And the deal analyzer, we took information from everybody about what their favorite metrics were. What do they look at? They look at economic vacancy. Do they look at the IRR? All these different metrics. And so everyone was able to contribute and come up with different ideas. And that made that tool. And then we did the same thing with a sponsor screener, where we just have questions that we ask new sponsors, because all these deals, you call up and you have a 30-minute or an hour conversation with a sponsor. You don't know anything about them, and you're trying to get to know them, and you're trying to find out about their business, and they give a little spiel, but it's nice to have a set of questions you can ask. So I think just the sense of community is what I've gotten most, and what I've learned. So it's both through preparing and trying to set up a meeting and set up a group and have some expertise in that I learned from, and I took little pieces from everybody, but then also just the confirmation of the different syndicators. Here's a different way to look at it. And so, talking to the other members of my group, they might have a different take on a syndicator than I do, and just sharing that information. So there isn't anything really specific. It's just more general, just the community, right? I wanted like a mastermind almost. And that's what we ended up having. And I think what I've really learned is it doesn't matter what your expertise is, because you can all learn from each other. You mentioned smaller investors or younger investors. One of the groups that I started with TribeVest was a group we put in $100 a month, right? We have 11 people in the group. None of them had ever invested in any real estate at all before. None of them had done any syndications. So we had, again, Zoom. I don't know how we would have done this before Zoom or before the pandemic, to be honest. But so we would have, these meetings where I would educate them on one part of the syndication, the next part, and then give everyone homework, and they'd come back. And, we didn't know when we'd ever be able to invest because they're all non-accredited. So that was another hoop that we had to get through. But, in the end, everyone did a one-time lump sum of $1,000. And within 1 year, we found an investment. We all decided together and voted and did all that. And everyone invested in their first real estate syndication. It was just a great process, but I learned just as much from them as they did from me. And so that's the kind of experience I think I like. And that's what draws me to real estate, is you can have those kind of experiences.
I love that, because I think something we've been speaking about so frequently on our podcast, at least the last couple episodes, is that the lack of knowledge for the passive investor, and those groups basically can have a super sophisticated individual or somebody that knows nothing. And just by sitting there, you're going to pick up pieces of information and knowledge that is going to hopefully help you decide good deal, bad deal, good sponsor, bad sponsor. And it's something that I truly believe in, because I think there's so much out there right now, and anybody could become a sponsor. And there's so much that people don't know, that these little communities are tribes. And by the way, I did look it up. Our TribeVest was like April 14th. We had him on our podcast. Okay. So anyone listening, I mean, it's a really, for the new investors or super experienced investors come out there, something that, Jim is doing now. And you could create that group of people where you're the individual that can educate, and there's a contribution, and you guys can figure it out. It's going to save so much hurt that's going to, or potentially could happen. Not that anyone wishes it, but there's so much that could go wrong. So I think what you're doing is fantastic. I love it. I've always said, real estate is a game of education, knowledge, and contacts. And what I always set out to do, we used to host a monthly meetup event. We didn't go online. We just decided to cancel it. But I always said, my vision of real estate, when I started, similar background, I was in finance. I hated it that you had no control over what you were buying. It was not a physical asset. I switched to the real estate space, and I got a lot of help from when I started to where I am today. And I always said, my vision of real estate is a country club environment where people could come, you can do deals together, you can do deals with the sponsor, but it was a place of education where if something went wrong, at least you had a platform or a forum where you could say, wait a second, these two tenants are fighting because the music is too loud. How do I go about this? Has anyone dealt with this? Can you give me ideas? Because I'm drawing a blank. So it's something that I truly believe in. And I love it. I think that this needs to be done more the education of passive investors. We have an investor right now. I will gladly make the introduction. He's actually trying to create something that I think you might have already got a head start on. He wants to create basically a rating system that sponsors can't rate themselves, but it could be from the passive investor to come out there and say, hey, I've invested with these guys, good, bad, and different. And it allows investors to channel their experience as opposed to sponsors to stand in there and say why they're all the best. Meanwhile, this deal may not be forming. They're not good at communication or whatever it is. So I think that's, it's an awesome thing. And I am a sponsor. I raise money. So I'm putting my hat in the advocacy that we should be taken out of the equation, and it should be a group of individuals that get to voice their opinion.
Yeah, and that's something that I talked a little bit about the couple of tools we have for in our left field investors group, and we're developing two more. And one of them is a review area, and we're kind of, it's in the infancy what we're doing, but we're kind of trying to think, well, let's do it like Yelp, right, where you get a few stars in different categories, and then you can write comments about the syndicators, because there's no database. There's a couple of groups that do this already in limited fashion, and so we're trying to replicate that for our own group, so that you can kind of figure out who are the investors or the sponsors that are most liked by investors. And part of the problem is it's such a long runway, right? If I invest in a deal with you now, there's only two ways that I can monitor to see if it's going according to progress, and that's, are you hitting your pro formas, and are you sending out reports or distributions like at the time you say you are, and the amounts you say you're going to. Otherwise, I got to wait 3 to 5 years before it turns, and so it's really hard to get started. So that's one tool. The other tool that I don't see out there, and that I've talked to a lot of experienced investors that there isn't, no one's come up with a good one, which is tracking your own investments, right? I have 2 different Excel spreadsheets that feed each other and bounce back and forth, and it's a total disaster trying to track my own investments once you get more than a couple. And there isn't really a good software or anything targeted towards passive investors. And that's what some of the things we're trying to do with left field investors is we're really trying to cater to the passive investor. We're not trying to be GPs or try to get any parts of deals. There are some things that, maybe we get break on some minimums for some of our group if we do enough deals with somebody, but, we're just trying to help the passive investor learn, understand, and be able to figure out how to do these investments, because the putting 25 grand, writing a check for 25 grand or a wire for $50,000 for an investment that you've never seen to someone that you've talked to for 30 minutes, that is a daunting, terrifying thing, especially if you're only going to be able to do one a year, right? Because you don't have the capital, or only a couple a year. And you're only going to get $150 a month for the next, so it's really hard. And I think having a community where you could see, oh my gosh, 7 people invested with this sponsor, and here's what they say about it. It just gives you a feeling of, okay, this is doable, where most people, all they learn about finance is max out your 401k. And, maybe they buy a few stocks on the side and they contribute $300,000, $500,000. That's totally different than seeing 25 grand disappear out of your account, hoping that the wire goes to the right place and lands with the right person, and they do what they say they're going to do. It's terrifying, right?
Mm-hmm.
I even from my finance days when, and this is how it's done or was done, and I haven't been in that space for a while, but it always shocked me that you could call a guy that you've never spoken to and tell him things that are so scripted that everybody says, and then they wire you money for a stock because it's a stock, right? There's a level of trust when it comes to the stock market that people sort of throw caution to the wind. But then in a real estate investment, which could be so much more fundamentally sound for a specific situation, you're right. I remember the first deal I invested in was a friend of mine through a group that we were part of. I had a deal, he had a deal, and it was one of them, well, I'll put money in yours, you put money in mine, let's diversify. But there was that level of trust that we were all in the same playing field. And it said, okay, you're doing the same thing I'm doing, but I'm buying a deal in Columbus, Ohio. He was buying a deal in Atlanta. And I said, let's diversify, right? Let's split it. Hindsight, my deal turned out to be significantly better than the other one. But at the end of the day, you're right. The education level that needs to go in for a younger, older individual to write a 25, 50, 10, even if it was a $5,000 check. And look, there are platforms out there and crowdfunding sites that'll take $5,000, good, bad, or indifferent. But it is a scary thing, like you said, when you've spoken to someone, even if you've tracked them online or Instagram or Facebook and you've spoken to them a couple times, even if you've met them at an event, to write a $25,000, $50,000 check for an individual is not an insignificant amount of money. And having a community where you can bounce that idea off or see other people are in that exact same deal, it'll give anyone a level of comfort. And I agree. The platforms that are out there for tracking real estate investments are tough. I've played around with different ones where it's really easy to track stock portfolio, 401ks, values of your own single family residence. But when you incorporate a $25,000 investment into a syndication, the information is so, you have to rely so much on the sponsor to give you information to track the value of that. And I think that's something that a space that's going to be an interesting thing to see who could come up with that first platform that can pull data or pull information and reports to show that, because having one place centrally located for all your real estate investments is important, because I use Excel as well. And, are you checking it monthly, quarterly, whatever it is? And it's something that I think new investors that don't have that experience would love to see, because it can show them, just like logging into an E-Trade account or whatever it is, where, okay, everything's right here. I feel a little bit better about it. Maybe I'm not getting the communication I thought, or the distributions aren't there, but at least I can see my platform to say, okay, this is what it is. I think that's a compelling tool that you guys can invent for your community, which would be awesome.
Yeah, and it is going to be a challenge. We're never going to be able to get the right value, because how do we know what the value is? And that's one of the things about these passive syndications that people need to understand. It is probably the least liquid investment you can ever make, because you can buy a multifamily or single family home, and if something goes bad in your financial life and you need to sell it, you can sell it. You might sell it at a loss, but you could sell it and get some money back. Same with anything in the market. But as soon as you send your money to a syndicator, they don't have to buy you out, and it's not, you don't have another market where you can trade this. So you're stuck for good or for bad until they sell the investment. And so even putting a value on it, if I put a $25,000 investment 2 years ago, trying to value it or get the syndicator to give me a value now is very difficult. So what we're trying to track are distributions and compare it to pro forma, refinances coming back and compare that to pro forma, and just kind of, see how the cash on cash return and the IRR as we go and things like that. So that's kind of our hope. And, if we can get it to draw the information from the sponsor website, that's kind of a next level wish list thing. I am hoping we can figure out how to do that eventually.
Mm-hmm. So I think you touched on something that I mini harp on a lot that I think is really important, is that how illiquid these things are and how little control you have when you do passively invest in a syndication. I think it somewhat gets the wow factor, like the now factor of, like, so many people are doing it. It's a way to put $25,000 into a $50 million building, and it's great. But I think that's why I push back on passive investors to really educate themselves a lot before they do it. Because like you said, if you decide to buy a quadplex and you mess it up, you can do whatever you want with that to a large degree. When you passively invest, if you mess up and you don't understand the mechanics behind it or what you're getting yourself into, you don't do your due diligence on the sponsor, the deal, the location, the management company, there's nothing you can really do about it besides just kind of write it off and chalk it up as a loss. So there is a significantly decreased amount of control that you have, where you have very little control, if any, depending upon the operating agreements, the documents you have with that sponsor, et cetera. So I agree with what you said earlier of that it's up to the sponsor's job to underwrite the deal. I agree with that 100%. If you try to underwrite every deal that comes into your inbox as a passive investor, you're going to be wasting a ton of time. But I do think there has to be a level of accountability on the passive investor to educate yourself to a certain degree, or have the mindset of, if I invest $25,000, it's gone. And if I get it back, or I get it back in a return, then it's great, because it is so different from investing in the stock market, buying your own real estate, buying gold, investing in bonds. So I do think there is that little bit of difference in it. And that's why I think your group and platform, what you're doing is so great, because it's helping those people who don't have any level of education or very little, can lean on people who are doing the same thing and not have to rely on someone that may or may not have an ulterior motive to get educated and feel comfortable and understand exactly what they're getting themselves into, and how little control they have and how it stacks up against all these different possible investing avenues. I just think it's so helpful from that degree.
Yeah, I agree. And I think part of it is, if you're investing 25 grand in a syndication, it can't be the 25 grand that if you lose your job, you needed to feed your family.
Exactly.
Right? It's got to be, I have 25 grand. If it disappears and never comes back, we will be okay. I think one of the benefits of real estate is you always have an asset behind that 25 grand, right? So even if, worst case, the syndicator runs it into the ground, it's a horrible investment, everything goes wrong, you're likely to get some of that back, right? You're not going to, it's not going to go to zero, where, I feel like sometimes in the stock market, you can drop by 50% or even more. And it didn't have anything to do with that particular investment. Just the market decided to tank and it tanked. So that's why, I still go back to the investments. But you're right. When you're investing in these things, you have to segment your finances so that you're only using the money that you can actually not afford to lose, but afford to have illiquid for an extended period of time. And I think that's important. And I think going back to, the due diligence that the investor has to do, for me, and I don't know, how you divvy this up as percentages, but the sponsor is the most important, the number one thing, right? Is you got to get to know the sponsor. If you can get to a point where you think they're doing a good job, you trust them, you've talked all that, then any deal that they're going to bring to you, as long as it fits within the parameters of their expertise that you've already evaluated, then it's really just, hey, is this in the market that you like? And is this deal, does it hit all the metrics? So, in our tool that we have probably 20 to 25 different metrics that we've come up with. And the tool doesn't really say, is this a good deal or a bad deal? But if one of the metrics falls outside of our range, then the cell turns red. If it's inside the range, the cell turns green. So even if, if it comes to us and someone says, hey, the IRR on this deal is 25, in our metric, that's going to turn red, right? Because that's awesome, 25 IRR, but it's also higher than we should be expecting. So then we just ask questions. So as you go through this tool, if 5 things turn red, that doesn't mean don't invest in the deal. That means here's 5 questions that you have for the syndicator that you've already vetted, right? You already trust, you already know this syndicator. So now you're just communicating. And I have never had a syndicator come back and say, I'm not answering that question, or that's a stupid question, or every time they have answered every single question I've asked. And if they didn't, and that tells me enough, right? If it's the first time I've dealt with somebody and I have 7 questions and they don't have the time or want to take the effort to answer my questions, well, then they've answered it, right? I'm not investing. So I think there's, I don't want people to think that they need to know how to underwrite a deal like you guys would as a sponsor, right? I don't, and that's not passive to me. And that's why a lot of these tools that you see out there that people are marketing to passive investors, they really just dress up their own syndicator tool and say, hey, here, analyze this. And you're digging into the T12 and T3 and you're knee deep in it and have no clue what you're doing. Well, I don't think that a passive needs to get that deep into it. You should understand those terms, but I don't know that you need to dig into it that much. You need to understand it enough to put it into whatever tool or metric that you're using. But I don't think the underwriting is where, at least personally, that's not what I want to do. And I know that's not what you were saying, but just the distinction is important in my view.
Yeah, I agree 100% with what you said. It's not, if you're doing all that, you might as well go get a job and do it for somebody else and get paid along with being a passive investor, right? So 100%, there's got to be a really good balance. And I think and I think for me, it's just that ability to understand that, hey, I'm giving up control. And like you said, nobody should be putting their last dollar into it. I think only a certain percentage of your invested dollars or your net worth should be in syndications. It should not, you shouldn't have, in my opinion, 80% of your net worth in syndications. I think that's far too high, even if you're overly diversified. So I think there's a balance to everything, and it's just understanding exactly what you're getting yourself into. And at the end of the day, if you're comfortable with investing 50,000 on the off chance that you might lose it all, and you don't really feel like digging into financials and the underwriting and you like the sponsor, that's up to you at the end of the day. But I just think people need to understand the difference between syndications and other investing avenues, and that it can be all lost. And the one thing I will push a little bit back on what you said is that, yes, you're investing in hard assets, but because almost all the syndications have leverage and debt, it is very possible, in my opinion, that it can go to zero. Whereas if you were to, the stock market, a stock can go to zero, but if you're in like an ETF or an index fund, those I think can never go to zero unless the stock market disappears. So because of that leverage, if it was an all cash deal, I'd agree with you 100%.
Yeah.
But because of leverage, I think there is that possibility that it can go to zero. And I think that's a larger problem that a lot of people have, is they have the same mindset of, hey, this is a hard asset, it's land. You can't make, there's the famous, I think, Roosevelt quote, like, they're not making any more land type deal. But if you have leverage, the bank is your partner for 70, 80, 90%, depending upon how it's structured, 60%. So you have to understand that relationship. And I think after the sponsor, after the location, I think understanding the capital stack of where the money's coming from, who it's coming from, what are the terms behind that money? I think that's probably arguably the third most important thing that passive investors should look for is, okay, who's the sponsor? Who's the person running it? Where is this deal located and what is the quality of it? Because you can't change that. And then where is the money coming from and what is the makeup for it for this deal? And where do I stack up in that? Because those things are changing now and getting more sophisticated as people throw in things like preferred equity or mezzanine debt or bridge debt or, agency loans, CMBS, understanding all those things and having a general idea of what they mean. And then are you common equity? Are you preferred equity? And where do you stack up? I think for me is probably the third most important thing. And again, you don't have to understand exactly what everything means, but you should know what roughly a Freddie or Fannie loan means versus what a bridge loan means. You should understand roughly what preferred equity means versus common equity. And again, you don't have to read the whole 30-page document, but just a rough idea of what that means for you and your dollars, I think is hypercritical as well.
Yeah, and I agree with that. I think part of it is, if you are diversifying by asset type, meaning multifamily, mobile homes, self-storage, the typical ones, and you're diversifying by market and you're diversifying by sponsor, then I think your risk goes way down because you're diversifying. That's the definition of diversifying. So I agree with you. I would also say, if you're going to looking to retire and you have $1 million, right, and it's all in the market, as a former financial advisor, I would say, okay, you can take out 4% a year because you're not going to ever dip into your $1 million because you never know you don't know how long you're going to live. So you take your 4% and you live off 40 grand, and that's the best you can do. But if you are investing in, and say you were going to put $1 million into 20 different syndications, now you're going to collect 8%, right? Because most people are going to get 8% on cash return on these deals, or even if it's less, you're going to pay a lot less taxes. Now you have sustainability, because although I don't really count on the appreciation, most of this real estate, when you look at the pro formas, they're over 5 years, they're going to approximately double, maybe not, but I don't even think about it, but that's not what I'm relying on. So my point is that if you compare the two approaches, like the standard approach, take your 401k, live off that 4%, even if you go to 6%, whatever, you're living on 40 to 60, you never touch that $1 million. That's going to your kids when you die, because if you dip into that, then you're going to start, you start a roller coaster of problems. But instead, if you put that into syndications or real estate in general, that's an asset that produces cash flow, then the appreciation is gravy, and you get all of the cash flow constantly and the tax breaks. I mean, it's a no-brainer to me. Now, back to what you were saying about it could go to zero. You're absolutely correct. But if you're in different sponsors and different properties, and you kind of eliminate some of that risk, and then it goes back to, don't put all of your only asset be in this syndication. And that's why, I think for people that maybe can't do a bunch of $25,000 or $50,000 investments a year, you do a bunch of $5,000 ones. And John said you can do crowdfunding, or you could do something like TribeVest, where you join up with a few other like-minded individuals and you put some parameters around it and you go invest in a few deals, but you get that diversification. So, that's one of the things I take from, my old days in the stock market and all that, is diversification is absolutely crucial. And it is hard to get diversification in passive syndications because you have to build up to it. And so if you can find ways to get it more quickly, then I think you're reducing, not eliminating, but you're reducing what happens if one of my investment goes to zero because of the leverage. That's a great point you brought up. But if I have 10 different syndications with five different sponsors in 6 different markets, the chances that that's going to happen to all of them is very slim. Maybe one, but even that I think is relatively unlikely.
Agreed. Yeah, I think diversification, especially as you start to get a little bit older, you start to have more discretionary capital, more funds. Agreed 1,000%. And I would be shocked if you had 5, 10, 15 in different asset classes, locations, business plans, etc., that they would all go to zero if any of them go to zero. I don't think it's a large likelihood. I just think it's important to know that, which is why I think some of the things you're doing allows people to diversify a little bit earlier. But I also think if you're younger, trying to build up capital, you can be a little bit more risky. Take some more chances, put money into something that has a higher risk reward thing. So I think it all depends where you're coming from and what you're looking for. And I think it touches on, when you were talking about a tool, I think another great tool that people should look into and learn to develop, and you touched on it a little bit, but it's kind of like a discount rate for people. And it's basically coming up with metrics that are important to you personally and kind of trying to assign values to them. So one of the things you look at is like market, right? And it might be you want to be in, A class, top 10 metros because you are older and you're looking to diversify and you want to protect your capital. Well, a Raleigh, North Carolina may be weighed way better than a Mount Pleasant, South Carolina, because it's larger, it's got more people moving there, it's well known, it's got a lot more resources. So if you had a like for like deal, but one's in Raleigh, one's in Mount Pleasant, the discount rate assigned to Mount Pleasant would make that deal worse. Now, a lot of people can do this just thinking about it, right? That one factor. But when you start to throw in multiple different things and you can assign value to them, like rate them a 1 to 5 or 1 to 10, well, then it can spit out different things that you can see. Okay, well, no cash flow year 1, but higher cash flow in year 5 versus one that's more steady across the board, or, the riskiness of a retail deal versus a multifamily deal. Those are the things that people should also be looking at. And, you can kind of tailor it to your own thing. So if you're looking for higher risk, higher reward, or you're looking for more diversification, safer, you can kind of play those things against each other. And one caveat I'll add to too, where I said the capital stack is probably the third most important. I wasn't thinking this, but asset class is probably in that list somewhere. Is it multifamily, mobile home, self-storage, et cetera? Right. I don't know if that's 2, 3, 4, wherever it is, but it's in the top 5. So that's another one to look at. But yeah, I think you're touching on that a lot too, of where people need to understand what's right for them at a certain point in their life, and just kind of back into the deals that fit.
Yeah, and I think when people are trying to figure out what fits for them, I've seen a few people out there that have had the maps where you're trying to put your properties on the market, the type of property, and the type of asset, and trying to figure out where that is on a risk reward spectrum. And that's something else that would be interesting, to be able to plot all of your own personal investments on this graph and to see where it is. And you'd have to come up with those metrics. And so that's another interesting thing that we're thinking about. The other thing that you made me think of was, most people that work in the W-2 world have one income stream, right? That's their job. And if they lose that, they're done. And so one of the things that I really like to talk about and is important, I think, is developing multiple income streams, so that if you do lose your job through, not in your control, at least you still have something coming in. And so if you can get multiple income streams, then eventually you can get to where maybe you don't even need your W-2. And then it opens up everything right now, because you can work because you want to, and you can work in an industry because you want to work in that industry, not because you have to. And so I think things like that are also what I don't think is talked about quite, but is in the active real estate everyone's trying to get to W-2 or get to the point where they can. But I don't think people in the passive area talk about that enough, because a lot of these people are high wage earners, but they only have this one income stream. And I think it's important to get multiple income streams. And I don't think that's stressed enough in our community.
Yeah, agreed. I mean, it's the basis of financial freedom. And I think the freedom, even as you're working, to take a harder stance on things that you might be more worried about, whether it's a policy at work you don't agree with, looking for a raise, taking on assignments that, would make you work significantly more hours. When you're reliant on that one stream of income, you're going to be, way more willing to do things you may not want to do. If you could basically quit tomorrow and be okay, or take a small hit and still survive, you're going to be way more comfortable in saying no to things, or trying to, come up with solutions that you might not have wanted to do otherwise. So even though you enjoy your job and enjoy working, it gives you the freedom and flexibility to, say no to things, or to compromise, or try to work things out, or take more vacation time, or, do different things, or go part-time, or do consulting on the side. It just allows you that basically the freedom to do what you want, even if you love that job. So I think what you say is important, because so many people do love their job and love what they do, but don't understand how that freedom aspect, that flexibility aspect, can be helpful, even if you don't imagine yourself ever leaving until you're 65.
Right. I think that's well said. It's just empowering when you have choice.
Yes.
Right. And so many people don't have choice. And, I went through, different careers in my life where I didn't have choice, whether it's because, I couldn't lose that job, or I needed healthcare, or you need this or that. And the, financial freedom is why a lot of people are in this and talked about a lot. But I think how you get it is, slowly building up those different streams. And, it all accelerates. It's all a snowball. These passive investments, when capital is returned and I still own part of the investment, but I have that capital back, and now I can go put into a new investment. Now I have two investments from the same dollar, and it just compounds. And so, like I said, the more of those streams, that's why I usually just invest the minimums in deals, because there's no reason, there's so many deals out there. There's no reason to, go all in on one deal when you can, put small amounts in each deal, and then you have those multiple income streams from multiple sources, different, again, same thing, asset type, sponsor, all those different things. I think it's important.
Awesome. We are coming up on time. I think that's a great place to wrap up. Jim, thank you so much for coming on. I think this is a great conversation, probably go on for another hour, quite truthfully. So we'll have to do a part 2 at some point. But if people want to learn more about you, check you out, follow you, where can they do all that stuff?
The best place is at our new and under construction website. So be kind. It's leftfieldinvestors.com. And you can reach out to me at jim@leftfieldinvestors.com. We're also on LinkedIn and Facebook. Those are small communities where our website is it's under construction every day. We've been building it out for the past month. So there's some pretty good stuff up there, and there's some errors. So we're fixing it if you're on there, but that's the best way to contact me.
Mm-hmm. If people want to be a part of the group or the meetup that you were talking about, is there a meetup group or a Facebook group that they should look for, or go to the website? That's the best place.
If they go to the website, there's a pop-up when you get on there that pops up. And if you put your email address in there, then you will be on our mailing list, and we're releasing a blog every week. We have monthly meetings are the fourth Monday of every month, and some various other things. So if they sign up on that list, they'll get notified about all the changes and everything we're doing at Left Field Investors.
Okay, beautiful. Guys, definitely go check that out. Thank you so much, guys, for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to somebody that would get a tremendous amount of value from this episode. Jim, once again, thank you so much for coming on. This was awesome.